Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education here at Schwab, and this is Getting Started with Options. The markets have been rebounding now. Would they be at a turning point? And at those moments, might some traders look to using options as a hedge on existing stock positions? That's what we're going to be talking about today. Today's going to be a guide to what are known as protective puts, which is using options as a hedge on existing stock positions. Should be an interesting discussion. We'll be talking about when they might be used, when the trader might take the positions off, the pros and the cons, lots to cover. Before we can get to any of that, though, let me first of all say hello to everybody out there chatting in already in YouTube. Hello there, John and Ricebird, MB, Will, Eva, George, Austin, Naresh, and Lawrence, and everybody else. Thanks for joining us week after week. We do really always appreciate your attendance and your contributions to these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, well, enjoy the presentation. Be aware that you're invited to join us in the live discussion. This is a Tuesday webcast series, and we kick things off promptly at noon Eastern. We'd love to have you here in the live audience. Also, I want to issue an invitation to everybody watching. If you're not following me on X, that's the best place to connect with me in between these live streams, and it's the best place to connect with any of your favorite presenters. So make sure that you're following us. If you have a favorite presenter there and you have an account with X, give us a follow. You can find me on X at Cameron May CS. But let's get into this discussion of protective puts, this beginner's guide. And as we do, of course, we need to pause to consider the risks associated with investing. These disclosures are important, so bear them in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation, or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as sole means of investment research, and investing involves risks, including the loss of principal. Okay. So with all of that said, let's set the agenda for today. Today is all about protection or hedging existing stock positions using something known as a protective put. Now, if you followed through my introductory series of lessons for brand new options traders, we already understand what a put option is. And sometimes trades can be used for speculation, or options can be used for speculation. They can sometimes be used for income. Today's all about hedging, though. So what we're going to do is take a quick peek at current stock market conditions and just discuss for some why it might be at an important tipping point for stocks and why some traders might feel the need for hedging or protection right at this moment. Then we're going to talk about this strategy known as protective puts. We're going to talk through the pros and cons, how it might be done. And before we're done, we're actually going to be adding protective puts to existing positions in an example paper money portfolio. So should be good. We're not just doing theory here. We're also talking application. So let's go right to Thinkorswim. So this is a Thinkorswim desktop trading software platform. It can be downloaded free of charge from within your Schwab online account. You just go to schwab.com, log in, go to the trade tab, and then just look for Thinkorswim. All right, but here's the S&P 500. And if you've attended any of my recent webcasts, just in the last few days, we've been keeping an eye on something that for some traders might be an important tipping point, and that is right around that $5,500 level, or that 5,500 in the case of the index, point level. Now, these big round numbers can by themselves sometimes act as important areas of support and resistance. So if we're just below a big round number like 5,500, some might just on that evidence see that as a potential price ceiling. Now, a couple of other reasons why that might be seen as a price ceiling is that it previously served as a price floor if we're looking at the diagonal support that's been rising throughout the year. Over the last year and actually stretching beyond that, if we go to a longer term chart, let's look at a 3-year weekly chart, you can see that this diagonal area was previously a ceiling. It acted as a price floor all the way through 2024, and then finally we broke down through that in just recent weeks. So that was a second reason for some why that 5,500 level might be an important turning point. Now, a third is that we did touch twice at that level, right here and right here. That looks like that was at a horizontal area of support. And I actually sent an X post out, made a little video. Is this a potential W pattern, a potential bottom from this sell-off of about 10.5%? Didn't turn out to be. It actually never confirmed as a W, because with a typical W pattern, which is basically a pattern that looks like a W, it would be confirmed if we reached the highest point and exceed it between the two lows. So yeah, had we popped back up here to about the 5,800 level, that might have been confirmed by some as a definitely a W, and then the technical expectation from there might be to rise possibly up to previous highs. Anyway, so bottom line, that $5,500 level may be a turning point for stocks. Now, could we push up and through? Of course we could. Oh, one more thing. Why not? Let me throw in just one more thing. You saw me do this yesterday. Let's do it one more time. For those that use Fibonacci's, that this actually represents the 50% retracement line from that high down to that low. So let's just click on our Fibonacci retracement tool and look at where that 50% level is. Go to that low, up to the high, right about there. And you can see there's that 50%, and it coincides pretty nicely with this confluence of horizontal support and resistance, diagonal support and resistance. So there's that price ceiling. Now, not every trader is going to agree with this premise or this outlook for stocks. The stock market actually has a decent amount of momentum right now. So we'll see if we continue going higher, in which case protective puts might not be a good idea. But for today's discussion, let's put ourselves in the shoes of a trader who thinks we're about to bump our head and stock prices are likely to head lower. Now, if that's the outlook, of course, for some traders, they might determine, well, okay, maybe what I'll do is just sell some of my stocks. And then if the stock market does turn down, I have less exposure. Obviously, that also limits the upside potential of a portfolio if we've gone to cash. Now, alternately, a trader might employ a strategy to hedge existing stock positions. And for today's discussion, what I want to focus on, a couple of stock positions that we have here in our example paper money portfolio. I just added them for the purposes of this discussion, but we're going to put ourselves in the shoes of an owner of some shares of Colgate Palmolive and Walmart. So we have 100 shares each on CL and Walmart. Let's say we purchased Colgate Palmolive at 88. We purchased Walmart at 80. Current prices have moved more toward the $95 level. So how about we use Walmart to set up this example discussion? All right. So let's say we were among the very fortunate group of traders who were able to buy Walmart at recent lows right down here around that $80 level. And then Walmart has, over the course of just the last week and a half, really risen sharply. It's come up from $80 up to about 96. Pardon me. I had to mute myself for just a moment. But in any case, Walmart's actually up about 20% in just the last week and a half. Now, if we owned those shares from down here at 80, this has been a relative joyride. This has been fun. Watching that 20% of profits build into this position. But look at where today's candle has, at least for now, hit a peak. We've come up to that about 96. That was a previous price ceiling. And even just within today's behavior, if I zoom in, those of you who use candlestick patterns, what might this be described as being right now, just from what it looks like at the moment? Maybe not a perfect example, but decent enough. We have a small-bodied candle with a tall wick sticking out the top and almost no wick sticking out the bottom. What might you call that? This is sometimes referred to as a shooting star candle. For technical traders, that might imply that we're up at a resistance and likely to move back down to support, wherever that might be. Maybe it's down at $90. Maybe it's a full return to 80. Kevin, oh, it could turn into a tombstone. Yep. Yeah, if this flattens out just a little bit more, and actually if our body were a little bit flatter, and if it were a little bit closer to the bottom of this candle, yeah, it would be a particularly strong candidate for a tombstone doji or a tombstone candle. Tombstone doesn't sound like fun. Yeah, it's also intended to identify a potential bearish reversal in price momentum. You know, for whether we call this a shooting star or a tombstone candle, both of those mean that we've opened down low, rocketed up, and then come back down during trading. So we've surrendered previous or gains that we had earlier in the trading session, and we've actually surrendered essentially all of them, coming right back down to where we were. You can see how that might be seen as an important intraday reversal of sentiment. So let's say that our trader, who's feeling pretty good about the profits they're sitting on, is now concerned that price might pull back and could pull back substantially. Now, of course, the trader might decide, well, let's just take the profits. Let's just sell the shares. Well, rather than sell the shares, what if we were to hedge this position, hopefully reduce some of that risk exposure? So rather than sell the shares, we're going to enter into a contract that gives us the right to sell the shares if we choose to at any time for a given period of time. So let me just zoom back out here. Anyway, I think you get the feel for this. Let's say that there's a concern that maybe with this thing having gone up so quickly over the last week and a half, since stocks have a tendency to go up quickly, and they can come down even faster, like right here, we went up quickly and then came down about twice as fast. Maybe our trader is feeling like, ooh, it'd be nice to have a little bit of protection, a little bit of a hedge for the next, I don't know, week or two. So let's go do an example protective put. So here's what we're going to do. We're going to go to the Trade tab. And the first thing that we need to do is select, well, how much time do we need on this contract? Well, if we think that our stock is going to go down for, let's call it a week, are we going to buy a contract that's going to expire in 2 days? Probably not. It's not enough time. 10 days, that could be sufficient. What some traders will do is they'll gauge how long they think the danger is there for our stock, and then they might double that time frame. So if we think that there's a risk that we're up at resistance, we think that we're likely to have an answer within the next week, well, let's extend that out to 2 weeks. So that might carry us to maybe to the 25th of April, possibly even out here to the 2nd of May. I'm going to do those contracts. Let's look at the 2nd of May. Those contracts have 17 days. And what we're going to do here is choose a strike price. Basically, what we're doing is entering into a contract, as we've learned. By the way, if you didn't learn this, if you didn't get to see my series of lessons that I built for beginners, let me show you that. Let's go to our Trader Talks channel so I can bring you up to speed. I don't like to make assumptions about what people know. So if you're not familiar with puts just in general, they're included in a series of 10 lessons that I created and delivered just to help a brand new beginner, doesn't know anything about options, learn about options. And we go from just talking about the basic elements of a contract all the way up to trading what we call multi-leg or more advanced strategies or combination strategies. So in any case, if you haven't subscribed to our YouTube channel, do that now. You can go down and click on the subscribe button below the video stream. But our YouTube channel is where we house our previous webcasts. So the channel name is Trader Talks Schwab Coaching Webcasts. Subscribe to the channel, then come find this on YouTube. And on our homepage, you can find our playlist. So you go to playlist, and then just scroll down toward the bottom. This webcast series, there's a whole bunch of them, whole bunch of webcast series on a range of topics. Mine's actually down toward the bottom, and it has Barb's face on it. Let me see. There it is, Getting Started with Options. And you can click on View Full Playlist. And as you scroll down through that playlist, you'll start to see Lesson 10, Lesson 9, Lesson 8. So puts were covered almost straight out of the gates. It's the second building block strategy that we discussed. So it's Lesson 2. All right. So let's go back here and start to select a contract that we're going to enter into. Now with the stock trading right about 95 bucks, Walmart's right around $95, our trader could decide, well, heck, we bought this at 80 bucks, maybe we just sell it at 95. That would be the realization of a $15 gain-ish, depending on where the trade fills. Or what if we were to come down to these strikes and we strike a deal with another trader where we have the right to sell our stock for $95 at any time for the next 17 days to this other trader? That's what this put would be. So here's going to be our deal. So we bought. So this is going to be our example trade. Protective put. And let's make this bold so everybody can see it a little bit better. Previously, we bought 100 shares at, in this case, $80. Now we're going to buy a 2nd of May $95 put. And what's that trading for right now? It looks like it's trading between 224 and 233. Let's use a nice round number. Let's say that it costs us $2.30 per share. So here's precisely the contract we're getting into, just to sort of walk back over the discussion that we had before. If you're not familiar with puts, we're paying $2.30 per share for the right to be able to sell 100 shares of stock. Notice the 100 here. These are standard contracts, but we're going to have the right to sell 100 shares of stock, which is what we own, at $95 per share. Not right now, but really at any time between now and the 2nd of May. So if the share value collapses, we now know, okay, that's okay. We have a contractual guarantee here. We have the right to sell shares anytime for the next 17 days. Not after that, but anytime between now and the 2nd of May for 95 bucks. And that can actually take a lot of pressure off the trader who's looking at something like this. Look at this. We just moved to red. So price continues to weaken. And if the stock falls, that's where this hedge comes into play. Now you might say, isn't this just plain old protection? Protection's a strong word. It's more of a hedge. A hedge means that we're taking some of the risk, or we're reducing some of the risk in the position. We actually have a pretty precise measurement to tell us how much risk we've just reduced our exposure by. Let's go back to our trade here. Because when I first started learning about this, I thought, oh, okay, good. So if I buy this put and the stock goes down $1, then this put makes up for that, and I've hedged dollar for dollar the downside on this trade. Not exactly. That's not quite the way it works, at least initially. Some of you more veteran traders here, tell me, if I own the stock for 100 bucks and I own this $95 put, and then the stock falls $1, what happens to the profit or loss scenario on my trade, on the trade overall? Did I just break even? Did I actually make money? Or did I lose a little bit of money? Because we know if we didn't have this protective put, and instead all we owned was the shares of stock, well, if the stock was worth 95 and then it falls to 94 and we own 100 shares, we've now lost $100 of either actual just loss if we paid more than that, or in this case, we'd be surrendering some profits, right? But how much? Yeah, NK says you're still not in the money? Could be. I want to talk about that, NK. That's a good question, because some traders might choose this strike price that I just used as an example. Others might go to different strike prices. But one thing that is key to really understand the degree of hedge that we've actually accomplished here is to look at our delta. Notice the delta is a minus 49. Delta, as we learned in our discussion of Greeks, and again, this is where those previous lessons come in that are so important. If you miss this, lesson 5, the vital role of options pricing and the Greeks, you may want to check that one out. But our delta tells us, well, delta makes a basic assumption, whether calls or puts. It makes the assumption, hey, Cameron, if you own this option and then the stock goes up $1, this is how this option is, that's how much its value changes. Now we assume that price and time don't have an impact. So if the stock were to pop up $1 very rapidly before volatility changes or before theta has a chance to kick in, yeah, this would be a loss. So if the stock went up $1, awesome. Hey, we own 100 shares of stock. So we made $100 on the value of that stock position, but this put position would actually lose value. When we buy hedges that turn out to not be needed, they can actually put a drag on the performance of our stock. Okay? Yeah, in this case, if the stock goes up $1, our put would lose 49 cents per share or $49. So what would be the net between the two positions? The 100 shares that we own and this hedge that we've paid for that's now putting a drag on things. Make $100 on the stock in unrealized gain, lose $49 on the option in unrealized loss, and actually our net position is still making money if the stock goes up. If we start to push up through that resistance, it still has the potential to make profit, just not as much, because this hedge is turning out to be unnecessary. Now, on the other hand, if we reverse that assumption, let's go to our charts here. Let's say that our stock continues to bump against this resistance and it falls $1. We might have had the impression, okay, well, this put just eliminates risk. It doesn't eliminate risk. It reduces risk initially. If the stock falls $1, we lose $100, unrealized loss on our stock position, or at least we're surrendering $100 of unrealized profits, right? But at the same time, our put actually makes money. The put value, assuming the stock falls just hard, time decay hasn't kicked in, volatility levels don't change, that put makes $49. That's what this delta means. So what percentage of a hedge do we have on that first dollar? 49%. We've reduced our risk potential by 49% on that first dollar. We've also limited the reward potential by 49%. Does that make sense? Because it works in either direction. That's sort of that's a trade-off here for adding hedges to a portfolio. I would love it if somebody just mapped out, well, Cameron, here's a free hedge that eliminates downside and has no impact on the upside. That would be amazing. It doesn't exist. But this is a strategy that a trader will commonly employ to limit downside. Now, an interesting additional thing happens to the hedging and to the drag effects as price moves further. Look at our deltas here as we go up in price or down in price. If the stock starts to rise, actually, our delta shrinks. So let's suppose we start off and notice our delta is in flux right now. Yeah, these Greeks change just as market conditions change. So our delta, if we were to buy the put right now, is 48. But George says as it drops, gamma should accelerate and delta will increase. Yeah, George, that's kind of a fancy way of putting it. I'm going to try to make it a little bit. You're exactly right, though, George. I got to say, nailed it. But here's what happens. Interesting thing happens with the put hedge here. As the stock falls further, let's assume that it's falling. As it falls further, it actually it positions our put deeper in the money, and our delta grows. In other words, on the first dollar, there might be 48 or 49% protection or hedge. On the second dollar, it might be closer to 55%. On the third dollar, 63%, and so on. Yeah, this put actually expands its protective influence the more it's needed. So if our stock is falling in price, our delta grows, and that put protection, that hedge, increases. Now, if the stock's going the opposite direction, If our stock starts to go up, yeah, initially it's applying a drag. If it goes up further, it applies less drag, and then less drag, and then less drag. Why is that the case? Well, it's because the losses that we're taking on the put, when compared to the stock position, there's just not much value left in the put. There's not much left to lose in that put. And as it decays down towards zero, the most we can lose on that put is the investment of $2.30. And we've taken a big chunk on just that first $1 move up. Second dollar takes a smaller chunk. Third dollar takes a smaller chunk. And eventually this investment works its way on down to zero. So the most total drag on our trade, on our stock position, that this can apply is $2.30. The most total protection that this can apply is actually, well, heck, we have the right to sell shares for $95. If the stock were to collapse in value, we have to subtract out how much we paid for the put. But other than that, it covers the rest. So let's do an extreme example here. Let's suppose we bump our heads against resistance, and the stock falls, and Walmart, what is it? Biggest company, is one of the biggest companies in the world. It's not the biggest. Anyway, one of the biggest companies in the world in the next 17 days closes up shop, closes all their doors, goes bankrupt, delisted. In that case, or let's just say it goes down to a penny in value. Okay, it managed to scrape by and keep one store open in Keokuk, Iowa. I don't know. Anyway, but the share value drops to a penny. Obviously, we're using an exaggerated scenario. Is Walmart going bankrupt or getting threatened with delisting in the next 17 days? Probably not. But if we got really close, we still have a contract that says we can sell shares for $95. We did spend $2.30 to get that deal. So after subtracting out the cost, that leaves $92.70 of protection, all the way down to zero. So this is it's a big hedge that grows as the stock falls. It shrinks in its impact as the stock rises, but there are pros and cons, and I wanted to talk through both sides of those. Okay, so how do we add this protection? Let's go ahead and who was it? It was, what were the initials again? NK asked about going in the money with our hedge. Let's just stay with an at the money hedge for this discussion. And I'm going to add it to our Walmart position. Okay, how do we do that? Well, just within the same portfolio where we own the stock shares, we just go place an order to buy one contract, or if we had 200 shares, maybe we'll buy 2 contracts of that put. So I'm going to click on the ask price, buying the one contract because we just own the 100 shares. That $95 put looks like it's trading now between $220 and $224. What did we say it was going to cost us? $230. Okay, the put has shrunk a little bit in cost. That means the stock price has probably gone up a little bit. But in any case, let's say we're willing to spend $225. We'll submit that as our limit order. There's a risk the order might not fill. We'll see. Buying one contract of the 2nd of May, $95 put, $225 is our offered purchase price up to that limit. There is a commission here to be paid, so that's $225.65 after paying the commission. But let's send this order off. Oh, and by the way, there was, let me just reread this while that is working. If I were to resubmit this, I'm not going to, but just remember, there's a little reminder down here. Please note that you've selected a weekly option series. So this is just a reminder. This is not the 3rd Friday expiration. It's one of the other expirations with a non-standard expiration date. Not every contract or not every stock has these weekly contracts, so we still get these reminders. Anyway, there we go. Let's delete that. Let's go back here to our monitor page. I think this is still working as a working order. We're offering to pay $225. It's trading at $221. Let's see if that fills. But as it does, I want to talk through a few questions about protective puts that maybe haven't been addressed yet. First of all, why did we choose the strike price we chose? Well, for this case, I just wanted to talk through the concept of a protective put. Now the trader, once they understand the concept, they might start to dial in on the customization of that, the application of that concept with things like, well, if I've selected an expiration, what might be the motivations to choose other strikes? So NK said, well, what about going in the money? Oh, there we go. We bought it for $2.25. Okay. Let's change that over here. So we bought that for $2.25 for our example. All right, great. Well, going in the money on a put means essentially, rather than buying the right to sell shares at or near the current price, we're buying the right to sell shares above the current price. Hey, that's literally at a premium. Let's use a nice round number again. Let's say we did the 100 strike. So if we were to buy that 100 put, instead of having the right to sell shares for 95 bucks, we would have the right to sell shares for $100, which is almost exactly $5 over the current market price. So there's an advantage there. We have to pay for that advantage. So notice the cost of that hedge has gone up. And in this case, it's more than doubled. It's doubled plus a little bit. But there's a trade-off. There are pros and cons to this. We've doubled the cost, but we've also relatively dramatically increased the value of that put. We have the right to sell shares for significantly a higher price. What's also happened with the amount or the degree of protection? The hedge amount. Well, instead of getting 49% protection, we're getting about 78%. In other words, if the stock were to drop $1, we lose $1 on our stock position, but we theoretically make 78 cents on the option position. Both of those unrealized, but that's how the scenario would change. Much higher degree of protection if it's needed. There's also a larger drag applied if the stock starts to rally. So if the stock were to go up $1 instead of down $1, well, our put would lose 70, actually I was saying 78, I was looking at the wrong strike. 86%, 86 cents on the dollar. So yeah, we're getting greater downside protection at the cost of surrendering upside potential. And there's more to lose here. If we spent $5 rather than spending $2.25, and it turns out that we didn't need the protection, we could lose up to $5 or $5.50 or whatever we wind up paying for that put if the stock continues to rally. So there's a greater and a more immediate degree of protection to the downside, but also a greater and more immediate drag on the upside. So what if we don't like that? Oh boy, higher cost, more protection, but more drag. What if I want to lower the cost at the expense of getting less protection, but also at the trade-off of not applying less drag? How about we look at the $90 put? In this case, we'd only be paying what? Between 63 and 84, maybe 75 cents. Paying 75 cents for a hedge, guess what? If we're comparing a 75-cent hedge against a $2.25 hedge, it's probably, there's probably less hedge being delivered. It is, yep. What's the delta on this one? 20 cents. Okay, so if we buy that, stock goes down $1, well, our put initially offsets 20 cents. If the stock goes up $1, our put initially reduces our unrealized gain by 20 cents. Yeah, so just using that delta as a general gauge of how much hedge and how much drag is being applied by the trade, we can really start to make an informed decision about which protective put we're choosing. So that was a good question, NK. I'm glad you did that. But another question is, at what time might a trader decide to put on these protective puts? if they choose to at all. By the way, just believe me, these webcasts are never intended to be a sales pitch for a specific approach to trading or a specific strategy for managing investments. But what some traders will look for, number one, is some traders who use charts in the planning and the management of their trades. They'll look for adding protective puts if price has risen up to and appears to be struggling at an area of resistance. So that's one possibility. And they can, we can get pretty fancy with this and say, well, what if we're at resistance, plus we have a bearish candle, plus we have a bearish signal on a favorite indicator or an oscillator or whatever. But yeah, using charts just to gauge when a protective put might be added, that's not uncommon. It also might be just in advance of a big announcement. Look at this. Do you think anybody out there sitting in Walmart shares, maybe they have a big position in Walmart, represents a large exposure of risk in their portfolio, and they're eyeballing this earnings announcement, starting to get a little bit, I'm a little bit nervous. Maybe I have too big of a position in Walmart. Maybe I sell some of my position. That's a possibility. Or maybe I just hedge some of my position going into an earnings announcement. That's a common approach to when a trader might choose to get into a protective put, or it might be for some other news event. There are lots of events that can affect the price of a stock that are actually somewhat foreseeable. For example, let's say there's a big court case, a battle, and it looks like it's going to be resolved the next couple of months, but we don't know when. Well, for some traders, they may not want to just sit on their shares exposed to the whims of the system to determine whether the stock is going to be severely impacted or not. Maybe they buy a protective put in advance of that hypothetical event. So yeah, before big events or when we're seeing bearish signals on a chart, at least through the eyes of our trader, that's when we might put the positions on. When might we decide to take the protective positions off? Well, let's suppose our trader put this on, and then our stock breaks on through, and it looks like it's just going to keep going higher. Well, at that point, maybe they sell the protective put for whatever they can get for it. Probably not going to get their $2.25 back, but sell it, retrieve what value they can from that put, and then just let their stock go on its merry way if it continues going higher. Obviously, prices will do what they'll do after that. So that's one thing. If the concerning technical scenario doesn't play out, that might be time to take off the protection. Or if it does play out, let's say that our stock runs down and then it starts to rise again. Maybe our trader decides, all right, I got past the scary time, let's get out. Now, obviously, if we start to run out of time on the put itself, maybe the trader decides to close up before expiration, especially if it's in money, because it can be exercised. If it's in the money, it'll be exercised, and the shares would be sold on the behalf of the shareholder, even if they didn't want to. If they let it get to expiration, if they didn't leave explicit instructions to not exercise, that contract can be exercised. Okay. Interesting. Yeah, George, I was just reading your comments there. Let's see what else. Okay. Yep. So John's making reference to the tariff scenario. Do you think that there are traders out there with maybe exposure to, let's say, sectors of the marketplace or stocks within the marketplace that have specific exposure to the tariff scenario? Maybe they want to look for protection. That's certainly a possibility. But of course, we need to weigh the pros and the cons. They're not all good protected puts, but they can carry potential value. All right. JB52 says, given the run-up in the stock price, how do you decide between buying a put or selling a call? Because we talk about both of these. Those in this webcast series, right? If we're really seeking a hedge, a traditional hedge, the protective put is typically selected. Selling a call can offer a little bit of downside offset, but not very much. really just the amount of the premium. Beyond that, there's massive downside exposure if the stock decides to collapse. In that case, the put would turn out to be the superior selection if the stock doesn't sell off much or it starts to rally. Maybe selling the call might have been the better idea, but as always, it turns out to be, well, what happens after the trade is taken. But let's do just the one more. Here's Colgate-Palmolive, our Colgate-Palmolive position, which, going back to our unallocated positions down here, you can see we own 100 shares, theoretically purchased at 88 bucks, now worth 95. Maybe this trader's looking at a similar scenario where our stock has really struggled to stay above about 97. You can see the last couple of times we've come up and touched 97, it's fallen pretty hard. Also, there's a big earnings announcement just around the corner. This is one of those scenarios where for some traders, if they want to hold the shares, but hedge some of that downside risk, maybe they go to their trade tab, walk through different strike prices, choose the delta that seems to provide the degree of protection that they're looking for at the price that they're comfortable paying, and go ahead with the trade. I think what we'll do, let's not add this protected put here. Just in the interest of time, I'll just leave it there. But guys, we've actually accomplished what I set out to do today. I wanted to talk through this concept of protected puts. This was our guide to protected puts, using options to hedge an existing stock position. I hope this was helpful for you. And this is one of those you might, if it's your first exposure to this strategy, maybe go back and rewatch this presentation a couple of times and do some practice trading in a paper money account so we can really understand the ins and the outs of a new strategy. But guys, thanks for giving me your time today. I'm going to set you loose to go enjoy the rest of our webcast for the rest of the day. But as you do, just remember, take full advantage of all the resources that are available to you. Number one, as I've mentioned, if you haven't subscribed to our Trader Talks channel here on YouTube, do that now. You can go down, click on the subscribe button. It literally takes a second. It doesn't cost anything. And this is where we house our previous webcasts under our playlists right there. Of course, you can join the live streams here as well. Also, make sure that you're following us on X. So you can follow Connie on X at Connie Hill CS. You can follow me there at Cameron May CS. But just be sure when following us that you are very precise with the handles. So mine is at Cameron May CS. We don't want to accidentally follow someone else out there. And there can be very similar handles. But this is the best place to connect with your favorite presenters in between these live streams. Hey, everybody, thanks also for all the likes. I can see 157 people watching. We have 47, about a third have already clicked that thumbs up button. That's always appreciated. That sounds like applause to me when I see all those likes. It also gives my webcast a boost in the YouTube algorithm. For each like, gets a little bit of a boost, helps more people find the webcasts and learn this sort of stuff, like learning about protective puts. All right, everybody, I'll let you go. I will look for you in a future webcast. I'll also look for an X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.